Hello and welcome everybody back to the Pulse here with the PeakBot team. I am Dillon, co-founder of PeakBot, joined by my co-founder and co-host Ben. We are back for another week of options trading here. We are excited to run through the call for today. We're going to change things up a little bit. We want to focus in a little bit more on some of the specifics with our strategies. With the wheel strategy, we're going to spend a little bit more time talking about the call side of things. We're going to take a look at just a few charts. Of course, we'll do some updating on my portfolio. I got a couple changes I'm making this week, and yeah, we'll discuss a couple things on the watch list, and we'll go from there. But yeah, excited. Ben, how you doing this morning?
Doing great. Ready for another strong week in the market, and ready to collect some premiums.
Awesome. Well, let's do it. Ben, we can jump right into it. I know we're gonna be going till right around 8:55 this morning, so we'll be efficient. Let's get to it, Ben. You want to maybe take a look at some charts, and we'll go from there?
Yeah, so I'm going to start at the watch list here. For anybody new to the stream, we do provide a watch list, and we are automating weekly options trading strategies. On this show, we specifically talk about the wheel strategy, whereby we sell a cash secured put, and then if we get assigned shares, we sell covered calls, and we're collecting premium along that whole process. In addition to just the sold put and the sold call, we are setting up a spread essentially. On the put side, we're hedging our downside, and on the call side, we're still allowing ourselves to participate in the upside. So the watch list that I have up here is taking a look at both sides really, but when we see estimated weekly premiums, we're looking specifically on the put side, because most of the time anybody that's automating the wheel strategy with PeakBot is on the put side. So if you haven't tried out PeakBot yet, you can click this button up here. You can try us for 2 weeks for free, no credit card needed. Feel free to hop in, integrate with your Tradier account. You could also download this watch list if you wanted to put like a filter on it and like sort the data in certain ways. You can't necessarily do that on the screen that I'm sharing right now, but you could certainly download the watch list and slice and dice the data however you'd like. So what we're going to be looking at and talking about today are these different companies that are near the top of the watch list. You'll see that we've got a trend direction built in. There are details on how we come up with that over here. We've got the risk level, and we talk about how we calculate the risk level over here. And that helps us kind of gauge, what stocks we might want to look further into, what companies we want to look further into before we go out and actually start automating our trades here. So we see SOFI is at the top of the watch list this week, and we see that the stock price is around $7.62. We see that our max loss here on this trade would be about $100. We need about $650 in cash in our account. We don't need to own any SOFI shares, but we just need that cash in our account in the case that we do get assigned. So we need $650 in our account to actually place this trade. And then the estimated weekly return is about $15. I'll talk about how we get to all of that in just a second. But I want to point out that you'll notice there's certain rows here highlighted in yellow, where the row, except for the trend and the risk level, is all highlighted in yellow. That indicates upcoming earnings. So we do have earnings dates listed out in this column here. We point this out because, as any experienced trader knows, trading during earnings is risky. There are big swings, both in your favor and out of your favor, and it's very hard to predict which way that stock is going to go during earnings. Sure, you could speculate and take a guess, but we just point it out because trading during earnings doesn't necessarily benefit us in any way, especially when we're automating, and it brings on an extra layer of risk that we might not necessarily want to take on. So we call that out. We call it the risk level. We call the trend. So if we're starting out on the put side, we know that when you sell a put or sell a put credit spread, that's a we essentially want the stock price to continue to increase. So that's a bullish to a neutral strategy, right? So when we're looking at trend here, what I'm looking for personally, not financial advice, none of this is financial advice. Just get that disclaimer out of there. I'm looking for either a neutral signal or a bullish signal. Me personally, I will take some risks. Like I'll look for stocks that are in the high or maybe even sometimes very high risk level if I feel comfortable about the company. But I'll look for a risk level that's like moderate, or if we keep going down, we'll start to see some risk levels that are lower. So like we see DraftKings here, bullish, lower risk, paying out less of a premium. We're estimating about 0.57% premium into the cash needed. So the way that we calculate that is I'm going to earn an estimated $21 in premium. I need $3,700 in my account to make that happen. So that 21 divided by the 3,700 is at 0.57%. Now this is on a weekly basis. So we can do this week over week over week. And if we don't get assigned any shares, then we just keep collecting premium week over week over week. Now, that's not always the case, though. The way that we have this wheel strategy set up and how it's automated on PeakBot is we're selling the 30 delta, which statistically gives us about a 30% chance of finishing in the money. Now, the whole goal of the put credit spread strategy is to finish out of the money. So flip that statement that I just said. We have about a 70% chance of winning that trade or staying out of the money. We also buy a put strike, and that gives us a hedge, and that's how we form our max loss. So we can see that on SOFI, on this first example here, we're estimating, I'll zoom in just a little bit more because we're going to focus in over here. We're estimating that the strike that we're going to sell on the put side today is the 650 strike. Now, we're also going to buy, and this is an estimate, of course, all of this can change when the market opens. We're going to buy the 550 strike. So that gives us a dollar spread, and $1, one contract equals 100 shares, 100 shares times that $1 spread. That's how we get to our max loss that we're pointing out here of $100. So we've got a max loss of $100 because what will happen is if the stock price, if SOFI continues to drop below 550, we will get assigned shares at $6.50. We'll be forced to buy shares at $6.50. And then those shares will be called away at, well, not necessarily called away, but the bought put will then be exercised and essentially allow us to sell those shares for $5.50. So creating that dollar loss. Dillon, is there anything you want to add in terms of how we set up our put spread?
No, I mean, other than just, the reason we select these deltas, the 30 delta and the 10 delta, which of course determines our strike prices, is sorry, I got a little bit of an echo, is because we want to allow you a high enough chance at success, right? Winning your contract, as well as collecting a fair amount of premium, right? This is kind of our sweet spot. And Ben, I believe you and maybe our development team are the ones who initially came in and decided on these deltas. Would you agree with that's kind of why we landed here? With the 30 delta, that means 7 out of our 10 contracts are going to, on paper, statistically, are going to finish out of the money, and you can call it a winning contract where you just keep your premium. You don't get assigned any shares. 3 out of 10, you will get assigned. So is that kind of the reasoning as to why you came across, those deltas specifically, or?
Yeah, and we've had some outside advice from ex-Wall Street guys on, where we could place these strikes and how we can get a solid win ratio, and also considering the net premium that we'd earn. But yeah, final point on the bought strike. That's the 10 delta. That means that there's about a 10% chance, statistically again, that the stock price is going to drop below this number. So you're only going to hit your max loss like maybe 1 out of every 10 trades. Now, saying it 1 out of every 10 might not be the best way to go about this, but it really depends on market direction overall, and then of course on a more micro level, stock direction. So what way is the stock price moving? But yeah, statistically, about 10% of the time, your max loss will trigger. But again, if you're being, proactive about choosing stocks with the correct trend and the proper risk level, and you're doing the right research into these companies before you actually start the strategy, you might even see more success than what the numbers show on paper. I mean, Dillon, you have your own rules. You set up your own rules, and we can talk about this in just a little bit. But back in 2023, we just did an analysis on your account. You made over 30%. I think it was like 32% on your portfolio. And all you do is go in and look at this list, set up a few stocks each week, depending on your risk tolerance, and kind of just sit back and let the bot go to work.
Absolutely. Yeah. The whole idea here is whether you want to be a trader or an investor, both are okay. The traders are the ones who live at the top of this watch list and roll the dice and take some risks. If you're going to do that, then stick to it, right? You don't just bow out after a couple bad weeks, right? If you're going to take these risks, know that these are still the most traded stocks, right? These are the most liquid options chains that you're going to find in this market. So, given enough time, these stocks are traded highly for a reason. And so, or being an investor is at the bottom of this watch list, selecting some of the more sure things, with the lower risk level, and a lot of them are more bullish. The DoorDashes, the Oracles, normally Amazon's down here, but Amazon's reporting earnings, I think, this week, so they've moved up a bit. But yeah, I mean, the whole idea is stick to it. So very cool. And then, Ben, I'm not sure if we want to do this now or later. I think we should focus in a little bit more on the call side, since we don't really give it the love we should. Totally. So go ahead.
Totally. So in this additional information table over here, we do talk a little bit about the call side. So when does the call side affect you, whether you're trading the strategy manually or you're trading it automated with PeakBot? The call side will come into play when you own the shares, right? So let's just say, for example, and we'll stick with SOFI since it's on the top of the watch list here. Let's say, for example, you sell your put credit spread this week, which means you sell the 650 strike, you buy the 550 strike. Let's say at the end of the week, the stock price at expiration is $6. Well, that falls between the spread that you set up. So you will get assigned shares at $6.50, but this bought put will essentially expire worthless because the stock price is above that strike price. So now you're going to own shares at $6. And then next week, what's going to happen is you will now trade a call credit spread. Now, if you're doing this automatically with PeakBot, we will just switch it on you. There's nothing that you need to do. The bot will be able to see the shares in this position and then flip the strategy and start selling call credit spreads on your behalf. If you're trading this manually, then you're just going to have to set up a covered call with a bought put at the deltas that we'll talk about here. So we sell, at least the way the PeakBot is set up, we sell the 50 delta, and we do that to collect more premium because the closer you are to the money, and even the further you get in the money, the more premium you will collect. So we sell the 50 delta. It's not always an exact science. It's going to be the delta that is closest to but less than the 50 delta. So sometimes that winds up being like 40 or sometimes even 35 if it's the lower dollar value stock, and there's a bigger percentage spread between the strike prices. So we're going to sell the 50 delta and we're going to buy the 20 delta. So essentially what this is doing is it's allowing us to collect more premium since we're selling a strike at the money. It's giving us a higher chance of getting those shares called away so we can get back to the put side. And the reason why I say get back to the put side, there's nothing wrong with holding shares, right? You should only really be trading this strategy on companies that you wouldn't mind owning. But we do get a lot of messages and support chats about people getting assigned shares, and they start freaking out. They're like, hey, why do I own this now? I don't want to own these shares. And our answer is hey, you're going to start selling calls on it. You're going to sell at the 50 delta, which again, on paper, statistically gives you a 50% chance of those shares being called away at the end of the week. So we're collecting higher premium, which also provides a bit of a hedge if there is a stock price decline and we don't actually get those shares called away. We collected a lot of premium, which should counteract any minimal movement downwards in the value of the stock price. But we're also buying the 20 delta call. And the reason we do that is if the stock price increases, and we see that it usually takes about a 7-ish% increase upward when we're selling these call credit spreads for this bought call to really have a big impact. If the stock price keeps increasing, well, we know because we sold this this strike, the call strike, at, for example, in this example, for $8. If SOFI keeps going above $8, we know that regardless of what's going to happen, we're going to have to sell those shares at $8. Now, could we get an unrealized loss? Yes, we can, but that's why Dillon mentioned you got to stick with this because the premiums over time are going to outweigh the amount of unrealized gains or losses in your account. So we know that if the stock price increases above $8, that we're going to have those shares called away at $8. We're going to have to sell them at $8. But if the price keeps increasing, then the value of this bought call is also going to increase. So now SOFI is a lower dollar value stock, so the price movement is going to be a lot greater. But if the stock price ended, not necessarily ended, because what we're doing is we're selling the bought call at around 10 a.m. on Fridays or on day of expiration. But if the stock value is moving quickly or above this strike price, like there's going to be value to be had when you go out and either manually sell this or have PeakBot sell it for you, automated. There's going to be value to collect back from this particular call contract. And we've seen instances where this call contract has increased in value like 400%, 700%, even 800%. I remember there was a trade back in December where I think it was Sunrun had really shot up in stock price, and then the bought call, whoever was on the bought call side, they got like an 800% return that week. So that was really cool to see. Those shares were, of course, sold at the sold call strike price, and then that bought call was sold around 10 a.m. ish on that Friday, and people collected a boatload of premium there. So that's what happens on the call side. Dillon, anything else in particular you think we should cover on the call side?
No, I think you covered it pretty good. It's just, to put it in layman's terms, if you finish in between your spread on this hedged version of the wheel, the vertical wheel as we like to call it, on the put side, if you get assigned your shares, there's nothing you have to do. The bot's automatically going to pivot into what we call phase 2 of the wheel strategy and start selling a covered call for you. If you're running the hedged version, we're also going to buy the 20 delta there just to collect some more premium and take advantage of the upside. So no, it's doing it for you. We give you the 50 delta because our traders prefer to be on the put side of things. As Ben mentioned, we want to give you about a 50% chance of getting rid of those shares immediately the week of you being assigned them. If not, that's okay. You'll continue to hold them. You'll collect more premium than you would on the put side, and eventually you'll get back above this. And what's really important to know is we have some traders who say, well, are you adjusting the strike prices to make sure that we exit our positions for a profit? No, we're not. There are sometimes you might hold the shares for a month and your new strike price is below what you got assigned at, and that it will sell the shares for a loss. That's the strategy. I know it sounds ridiculous, but that's okay, right? We're okay with losses. We just want to get rid of the shares, get back on the put side, and start collecting rent without risk. So I just wanted to make that very clear.
There's some expectation setting that we have to do. Like, nobody wants to lose, right? But we know that over the long run, there will be losses. If anybody's entering into an arrangement with any sort of like trading service and there's a promise of no losses, run as far as you can in the other direction. Like Dillon and I aren't here to tell you that if you use PeakBot to automate your trades that you're not going to lose. You will lose. I mean, we actually just told you, like, statistically, 30% of the time you're going to get a sign, and then 10% of the time you'll just outright lose. And when you do get a sign, there's a high percent chance that you're going to see an unrealized loss, or well, you will see an unrealized loss right away, just based on the nature of the strategy. But when you actually get those shares called away and you're forced to sell them, you might realize a loss. But again, collecting premium here. It's premium over the long run that's going to make it worth it.
Absolutely. So I'll pull up my screen here, and we'll just take a look at a couple things. I want to first show my equity chart from 2023, just to show that losses are part of the game here, right? So if we take a look at my chart from 2023, this is the wheel strategy. Keep in mind, I let PeakBot execute my trades the entire year on the wheel strategy, okay? And for a lot of it, we hadn't even introduced the hedged version of the wheel where we're selling spreads. I think we didn't introduce that till, definitely the second half of the year, maybe even the, July, August, something like that. But so as you can see, we're slow getting off to a slow start here, right? From May 1st through the end of August, I mean, we were untouchable. The market was in a really good spot. Again, the wheel strategy is a neutral to bullish strategy. We're looking for a neutral to bullish market. We'll talk more about our trend spread bot that's coming out soon. That'll be verse for all types of markets, including a bear market. But look, from the end of August through middle of November, I did nothing but lose. Okay, I did nothing but lose. The market had turned on us. I had a whole lot of unrealized losses as well as realized losses along the way here, but we had a recovery, and I still finished the year at 31.7%. I mean, that means up here I was probably close to 60, 65% on the year. We don't mind losing half our shirt if it still means we're going to finish around 30, 31%. PeakBot's goal, and we put it right here in our Twitter bio here, is, average annual return. Our goal, if we can return you anywhere between 20 and 40%, we're pumped. Okay. That's our goal. And that we get there by winning 0.5% a week, 1% a week from time to time, right? Knowing that we'll have losses.
Yeah, on that note, if you do take a look at our leaderboard, you'll see high percentages up there, right? Those percentages that are shown, 2%, 3%, 4%, Dillon's going to pull up the leaderboard right now. Those are based on the premiums earned. So you see last week, the top earner made about 3.1% in premium on the amount of cash that they needed to set aside on the marathon ticker. So while those numbers are high, this does not account for realized gain or loss. We're building that in so that way we can show a more complete view. But we do want to shoot for that 1 to 1.5% range in terms of premium on cash needed each week, so that way we can counteract any realized losses along the way. And Dillon's account is a great example of that. There will be realized losses along the way, but we're just collecting premiums as much as we can throughout the process. And Dillon, I do have to drop, but I'm going to leave it to you to wrap up this show and show people how they can use PeakBot and get a 2-week free trial. No credit card needed, but it was good this morning. Next week, we'll talk more about the unhedged watch list and strategy, because we didn't get to that. And then Dillon, as you mentioned, we can start to talk about the new bot coming out in a couple of months, the trend spread bot, which will be really cool. It's been requested by a lot of PeakBot traders, but I'll leave you to it.
Awesome.
And,
get out of here.
Have a good trading week, everybody.
Thanks, Ben. Appreciate you, man. So we'll continue rolling right along here. We'll keep things moving. So just for everybody, so everybody knows, if you want to identify my trading account, this is me here, YCUH. I earned about 1%, just north of 1% in premium last week. And these were the tickers I traded. And you can actually see that. We're going to go into my portfolio here, and we're going to make some changes as we do. Now, I want to make sure people understand, that, with PeakBot, if I was a normal user of this platform, okay, if I was just a subscriber to PeakBot and I wasn't the co-founder and we didn't build in time for me to look at my portfolio every week, I wouldn't be making changes every week. Okay. That's not really my strategy, because typically I wouldn't have the time to do it or the emotional capacity to get this done. But since we go live every week here on the Tradier Hub, I know I schedule 5 or 10 minutes to just take a look at my watch list, do some evaluating, and determine whether or not I want to make changes. Okay. The happiest customers, our happiest clients and traders here at PeakBot are the ones who set it and forget it. They just let the strategy do its job, right? This wheel strategy, this isn't something we concocted in our basement, right? This wheel strategy has been around for decades, okay? Millions of people trade this strategy every day. It's been time tested. Wall Street, hedge funds, retail traders. This wheel strategy has been around and has proven successful. So what's very important, as Ben mentioned earlier in this show, sure, we have a great watch list here set up for you to take a look at, and you should only be trading stocks that you're comfortable owning. Again, because 30% of the time, based on the deltas that we set up here, you're going to get assigned your shares. You're going to hold these shares, and we don't want you freaking out when you get assigned 100 shares of Marathon Digital Holdings if you don't know anything about the company, right? You might have a $300, $400, $500 unrealized loss, and panic sets in if you don't know what this stock's doing or why you own them or when you're going to get rid of them. It's very important to feel good about the stocks that you're trading, whether that's emotionally, fundamentally, or technically. Okay. So we're going to take a look at my portfolio here. And again, for any new listeners, I don't think we did maybe a great enough job of this today. PeakBot's built for the everyday person to put a stock trader in their pocket. You pick the stocks, our bots do the rest, okay? Our algorithms actually execute the trade on your behalf. There's a lot of systems out there that have been around for a long time that'll send you an alert or some type of notice that you should go and buy this stock or make this trade or sell this stock. That's great. It's better than nothing, but it's only as good as your reaction time. Okay. Remember, if you're busy, if you have a full-time job or two, or family, or you're on vacation or sitting in traffic or have a meeting, it's hard to respond to alerts right away. We take that out. We take that out of the equation. Today on the wheel, which enters weekly contracts, okay, Monday it opens, or Tuesdays if the market was open or if you forgot, okay, opens on Mondays or Tuesdays and expires on Fridays. Today around 11:30 Eastern, I'm going to get a buzz in my pocket, and it's going to tell me that my bot executed these trades for me. There's no better feeling than that. Okay, while you're busy, your bot's making trades for you. Emotions removed, time saved. Okay, keep that in mind. So let's take a look at my portfolio for this week. So I'm going to be removing two of these stocks. BTU, which is Peabody, actually has fallen off the hedged version, which is what we're looking at here. There's also the naked version of the wheel, unhedged, where we're not selling spreads. It's just naked puts and calls. Of course, if you have the ability to hedge your bet and protect yourself and provide yourself with more leverage, you should. Not financial advice, but the results speak for themselves. Okay. If I was to search, this is my approach, right? I search for BTU. Okay. Well, it's not even on the watch list. So if the stock has fallen off the watch list, it's for good reason, right? It's either not paying a good enough premium, which is the case here, or it's incredibly volatile, or the price is too high. We like to keep stocks for the most part under $100 a share on this watch list. That's not speaking for BTU, but just generally in speaking, because our average account size is really, I know this is a wide range, but we have people who start with $2,000, $2,500 up to, $20,000. There's certainly outliers. We have people with $500,000 on the wheel strategy this week, and they're going to make, probably $5,000 or so in premium, which is awesome. And believe me, they're trading the Amazons and the Verizons of the world. But so let's take a look. BTU is no longer on the watch list, which tells me it's not paying a good enough premium. I'm getting rid of it. Okay, so there's two ways you can do that. You can check this box here and click edit status and click remove, or you can just click on your active button here and it'll get removed for you. So BTU is gone. All right, freeing up some capital for me. We're going to take a look at Run. So I was assigned shares of Sunrun 2 or 3 weeks ago. So the last 2 weeks I have been selling calls on Run over here. All right. And so this past week, it had a good week. It recovered, and I was able to sell my shares. So now I'm back on the put side of things. I don't own the shares. I sold my 200 shares. I was running 2 contracts on it, sold them for a gain. And now I'm back over here on the put side. But if anybody who's watched the show before knows, I stick to my rules. I like to choose on this column here in my percentage of weekly return. Okay. I like to stick between 0.5% down here. Okay. And 1.5%. That's my rule personally. Anything that's above 1.5%, okay, for me starts to get a little volatile, right? The higher the premium paid percentage wise, the more volatile the stock is, okay? And I don't love dealing with volatility. I mean, you can see the risk level itself here. In fact, it's pretty poetic that right above 1.5, we start getting into the very high risk level. So what I'm going to do is, although this is a good stock and I've been trading it for a while, it's at 1.85%. It's trending bearish, which we don't like to see. On the wheel strategy, we're looking for neutral or bullish, okay? And it has a very high risk level, which tells me it's time to get rid of Run. All right, we're running away. So that leaves me with AFRM and TQQQ. So if we take a look at AFRM, it's right here, Affirm Holdings. I was actually assigned shares of Affirm last week. Okay, so I'm just taking a look at my portfolio on my phone here. So my cost per share on Affirm is $43. Okay, that's what I got assigned my shares at. So if we're selling call now this week, this is the part of the chart that the part of the watch list that I'm interested in. Okay, this is my sold strike and my bought strike. Now recognize this: the stock is now trading at $41.34 pre-market here, which means I have an unrealized loss in my account. Okay, I'm down $139, 3.2%. I'm not freaking out. Okay, because I know that I'm going to collect $94, about $94 in premium this week. All right, that's going to wipe out a majority of my losses as it stands. Now, hold on. Am I looking at the right line? Oops. I don't know if I am. Yeah, sorry about that. It's right here. I'm going to actually, even better, I'm going to make about $100 in premium this week. Okay. And my sold strike price is 42. That's saying if the stock gets above $42 this week when the market closes on Friday, we're going to sell the shares. Now, remember, I got assigned at 43. Okay. So that means I'm going to sell my shares this week if the stock gets above 42 for a loss, $100 loss. Okay. But I'm okay with that because although I have $100 loss if I was to sell these shares, I've already made that back up in premium and it gets rid of the shares for me, which means I'm eliminating my risk and I'm getting back to the put side where I'm just using cash as collateral, don't own the shares, and starting the wheel process over again. Okay. So if anybody has questions on that, feel free to put it in the chat. So I'm going to keep rolling with Affirm. Okay. I like the way it's set up this week. I feel good about it. We're looking at a bullish trend. I'm thinking that we're going to recover a bit here, and I'm looking forward to getting rid of those shares this week. And if not, I'm okay with that too, because I'll just keep collecting premium on the call side. Now, there have been times where on this show, I'll come in and I'll say, you know what? I got assigned shares last week. I don't like it anymore. I'm going to manually sell these shares, which you can do. Okay, this is man and machine. You can come in, you're in the driver's seat. All right. But if I still own the shares, I make the decision. Do I want to let the bot sell a covered call for me this week or a call credit spread? Or do I want to take matters into my own hands, get rid of the shares, cut bait, take my losses, and get back on the put side of things with either that stock or another one? Okay. This week, I'm deciding to roll with it, let the bot sell a covered call for me, and collect premium. All right. So we're going to keep rolling with Affirm. Taking a look at TQs. Let's find that on here. Here's the TQQQs. I like what we're seeing here. I was not assigned last week, which means I'm selling another put credit spread this week. So I'm looking at the left side of the graph here. It's trading at 55.44. We're in a bullish trend, which we love to see. Risk is only moderate, okay? Not high or very high. Risk is moderate. So I like that. My spread is $3, okay, which means I have a $300 max loss, okay, that I'm risking on this contract, which I'm happy with. I'm going to set aside about $5,300 in cash to open this contract, just in case we get assigned. And I'm going to earn $48 in premium, which is about a 0.9% return. Again, thrilled with that. Okay. So my strike prices this week are $53 and $50. That means if the stock finishes between these two prices, I'm going to take the shares. Okay. And I'm happy to do that. So I got a little bit of cushion. We got about $2.50 worth of breathing room here before we're getting to our strike price. So I'm going to keep the Qs here. I like it. All right. So to replace BTU, which was Peabody, and Sunrun, I'm going to actually add. I'm taking a slightly different approach this week. Rather than spreading it out, I really like this stock here, Zim Integrated Shipping. Okay. Falls within my range. 1.28% return on premium, which is a $16 premium per contract that I'm earning. Okay. So we're looking at a bullish trend, which we love to see. Okay. It is technically a high level risk. That's just based on the stock price and the spread. Okay. So that's how we do that equation. But I still feel very good about this. So it takes about $1,250 in capital to enter one contract. I have about, I think, $4,300 remaining in my account that I can use up. So I'm going to actually run 3 contracts on Zim Integrated this week. So I'm going to come here and in 3 steps, again, for anybody who's new to PeakBot here, this is how easy we make it to automate your trades. Okay. So click Start New Automation. And in 3 steps, I'll zoom in here. In 3 steps, you're in and you're out. Select your bot. Okay. The wheel strategy. You also have access to the Iron Condor, which we don't give a lot of love to because it's a neutral strategy and we're looking for a neutral market. Great strategy. Much like the wheel, it's been time tested. In fact, more traders know about the Iron Condor strategy than the wheel strategy, it seems, but just not my flavor right now, just based on the market trends. Okay. So the wheel strategy. Step 2 is select my stock. Okay. I'm going to type in Zim. All right. ZIM. And now it shows up here for me. Going to select that. And the final step is to determine how many contracts I'd like to sell, okay, or spreads in this instance since I'm hedging my contract. I'm going to enter 3. Now, you'll notice it says you need $6,000 available in cash. That's a buffer, okay? We build in a buffer to make sure that you have enough cash in case the stock fluctuates. That's actually a little bit higher. I'm going to take a closer look at that and, maybe see if our developers can correct that a little bit. But I'm going to hit activate, and that stock is now going to be added into my automated portfolio. I'll zoom back out here, and I'm ready to go. So for this week, I'm trading 1 call credit spread on a firm. Okay, I'm selling a covered call with a hedge. All right. TQQ is a put credit spread with a hedge, just 1. And I'm selling 3 put credit spreads. Okay, cash secured puts with a hedge, whatever. Sorry for all the lingo. And on Zim, I'm selling 3 of them. All right. So that fills up my 15K account. I'm slightly dipping into margin, which is okay if you have the margin available in your account. You don't want to abuse that. Okay. But if there's contracts you really want to run, then it's okay to do so. So that's my account for this week. I'm going to quickly show you guys the results. All right. So this tab shows you, I'm going to put it in light mode. Just think it's easier to see. So this is from last week, okay? So for example, I made $40 in premiums last week on TQQ. And here's the difference, right? This is my sold strike price where I'm earning a premium. And this is the hedge, our bought strike price, okay? You can see the different deltas and strike prices that we selected. So I'm earning 52 and I'm paying back 12 of it, which net premium is $40. And you can see the example here, for run as well. Earned 92, paid back 24 for protection. that hedge is an insurance policy. Okay. That's us protecting ourselves from any sharp movement downward. Okay. So, yeah, I just wanted to share that. It tracks all your premiums here. Very soon, we're going to show the realized gains and losses as well. We have the data. It's a nightmare to curate and get up on the platform and running and constantly accurate, but we're very close to getting that unlocked here for you. So just to keep in mind, PeakBot, easy, affordable, transparent. Okay. We're the only platform that's automating equities and options all the way through execution, who shares a full list of our traders' results. Okay. You can see everything on our leaderboard. You can go to usepeakbot.com/results for a more detailed version of that. But this is our pricing, $19 a month to get started. Okay. We bill quarterly or annually. You can actually save 20% by doing the annual subscription. So, look, get in here, get started, test it out. We have a 2-week free trial. As we mentioned earlier in the show, no credit card needed. All you got to do is integrate with your broker account, whether it's Tradier or some of the other platforms that we're connected to. Okay. And you'll be off and running. So that's it for my account for this week. I appreciate everybody hanging tight here. I know we're getting close to the market opening, so I'm going to give you some time to evaluate your portfolio and make some decisions. But again, if you have any questions, I'll throw the ticker up across the bottom of the screen. Message us at any time. Okay, we have a number below on the screen here, 973-888-1166. That's our business line. If you were to call that number right now, my phone would start ringing and I'd answer it. Okay, I'm here to help. All right, we have a full team available to help you guys understand how this works and how to make the proper decisions. None of it's financial advice. All right. And then on our app, there's a chat feature in the bottom corner, okay, which allows you to message our team at any time. I dare you to go 5 minutes without an answer there. We're here to help. All right. So really appreciate everybody hanging in there, even without my trusted co-founder, Ben. But whatever questions come up, don't hesitate to ask. We appreciate it. Best of luck this week in the market. And as always, signing off. We'll see you at the peak. Thanks so much.